Welcome back. Inflation seems contained in Canada for now. That has left the Bank of Canada free to lower rates. But will it stay low in the year ahead? Penelope Graham is Director of Content at Ratehub. Thanks for being with us, Penelope.
Hi, thanks for having me.
So it seems to me that the cut we got from the bank, of course, what we would call a jumbo cut, 50 basis points, the bank is simultaneously signaling it's going to move slowly from here. And I'm interpreting that as things could go either way. We could see inflation rear its head out again. We could see the need for more cuts because the economy is weak. What did you take away from kind of what the bank is saying?
Certainly. So the bank did send out some surprisingly hawkish signals in this most recent announcement. It did indicate that it's going to slow the pace and the frequency of rate cuts to come. And that's because it has now reached the upper end of its neutral target range. And again, inflation is already in that target range of 2%. So that means they can ease off of the stimulus a little bit. However, having said that, it is still widely expected that the BOC is going to end up at a terminal rate of around 2.5% somewhere in the latter half of 2025. And when that happens, we'll likely see variable mortgage rates responding by lowering to that range of around 3.5%. So Canadians can be assured that there are more rate cuts coming. However, there are a lot of factors that could change the trajectory of that cutting path.
For sure. And of course, one of the big ones would be a tariff war, some kind of trade war, either directly with the U.S. or indirectly. If the U.S. goes to war with China, we'll still feel the effect of that in a roundabout way. Where do you kind of factor in the inflationary fear here and what that might do? There's some scenario, Penelope, where we see rates going up again next year. I know that's a worst case scenario, but should people be prepared for that in some way?
It certainly is a possibility because, as you mentioned, if there is a tariff trade war, that certainly will be inflationary. There are some other factors at play as well. So U.S. CPI is already to be proving stickier than initially thought. There's already doubts being cast over whether or not the U.S. Federal Reserve will cut its own rate as aggressively as was initially expected. And those will be inflationary for Canada. It's going to weaken the loonie should that come to pass. So there is a possibility that we might end up in a situation where inflation is rising out of control and the Bank of Canada does have to react to that. But however, we can't say definitively what's going to come to pass.
For sure. So much uncertainty. For consumers that have been worried about their resets, 4 million mortgages in the next couple of years, what's your expectation of how much relief these reductions spell? Is it enough to make a difference?
So the good news here is that Canadians have been extremely resilient, even in the face of much higher rates, in paying off their mortgages. The delinquency rate for mortgages in Canada is still extremely low. It has ticked up to about 0.19%. So that is still quite low. And borrowers will have a lot of relief as a result of these most recent rate cuts. That overnight lending rate is now 175 basis points lower than when the Bank of Canada started cutting rates in June. And that is taking a lot of pressure off of that so-called mortgage renewal cliff. So that fear that everyone's coming up for renewal in a much higher interest rate environment, they're going to see their payments balloon. So now we are starting to see strong evidence that this won't be the case as drastically as feared. And with a few more cuts likely in the pipe, we're going to see further relief coming down.
So good to have you, Penelope. Thanks for your time.
Thank you so much.
Penelope Graham is Director of Content at Ratehub. Time for the takeaway and what goes up. It will be hard to talk investments of 2024 without Bitcoin coming up. The cryptocurrency had a moment or two this year, aided in part by the re-election of Donald Trump, who has turned positive on cryptocurrencies, along with his currently trusted lieutenant, Elon Musk. Bitcoin's meteoric rise, it crossed 100,000 in value in November for the first time, has many people wondering if they are late to the party, and many more thinking better late than never. That includes a few big-name money managers like the legendary Ken Griffin, who seem to be suffering from a major case of FOMO. But before regular investors dive into Bitcoin or other cryptos in a misguided effort to catch up, it's worth remembering that some of the very wisest investors, including Warren Buffett, are still firmly of the view that this stuff is toxic. Have some people made money on Bitcoin? Absolutely. Have some people made a great deal of money? Definitely. Does that mean it's a good investment? Not on your life. At the end of the day, something is a good investment if you have a way to value it. You can do that by an external measure, say the profit it generates and generally what multiple of that profit people are willing to pay. Or you can value it by personal factors, the way we value a house. It's not just an asset we might sell at a higher price one day, but hopefully also one we enjoy and that serves our specific needs in the meantime. What then to do with an investment like Bitcoin that has no intrinsic value, when all of its worth is based on what the next buyer will pay? That is precarious. Bitcoin enthusiasts might say that it has value because there are a limited number of Bitcoins, a fixed amount, around 21 million. And that part's true. This weird digital product of unknown origin is created by computer users cracking code, and whomever wrote the original code only allowed for a set amount of Bitcoin. If that sentence sounds to you like an argument to buy this stuff, you're probably already a believer. My takeaway? Thinking you missed out on a fun ride can feel bad, but catching a wave right before it crashes would feel even worse. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.